Right now, you are being told that metals are just having a healthy pullback. That is not what is going on. In the last few days, governments stepped in and started taking control of this market. They sat in a room and wrote the first draft of who gets saved when prices fall and who takes the hit. If you have a pension, a mortgage, a job in anything that uses steel, copper, or chips, or even a few coins in a safe, you are now part of that plan, whether you like it or not. Most people still think metals just move on fear and greed. That changed this week. Metals have been moved into the category of national supply, and when that happens, politicians stop watching and start pulling the strings. In the next few minutes, I am going to show you what they just agreed to, how this new critical minerals, club, and government stockpiles put a floor under certain metals, how that helps big players and leaves small investors exposed, and what that sets up for the next big move in this market. If you are new here, this is where we take the things that really move markets and explain them in plain language. If that is your thing, hit subscribe and hit like, because the metals videos over the next few months are not entertainment. They are a survival guide for anyone with a pension, a house, or a few coins in a safe. Let me give you the simple version up front. This week in Washington, Vice President J.D. Vance stood up in front of more than 50 countries at the State Department and said out loud what miners have been screaming for decades. The global market for critical minerals is not working. It is too volatile to support real investment, and the United States is going to try to fix that by building a club of countries that agree on one thing. They are now proposing a system that would put a floor under prices for key metals. Not a ceiling, a floor. Most people think a floor under prices sounds like some abstract diplomatic thing. In reality, it is a direct intervention in your future, because if they actually follow through, it changes how much mine supply comes online, how long shortages last, and how far these cycles can run before they blow up. We will come back to that. First, I need to make sure we are on the same page about one simple idea. What a price floor really does to a market. Most people think the price of a commodity is just a scoreboard. Buyers and sellers meet in the middle, print a number, go home. In reality, the price is also a signal that tells big money whether to build things or to walk away. Imagine you are looking at a copper project that will cost $10 billion to build. You have to decide whether to commit cash for 20 or 30 years. If copper can get dumped to half its current price anytime one big player wants to play games, you do not build. You wait. You let someone else be the idiot. If instead you are told, look, as long as you are inside this alliance of countries, we will not let copper prices fall below a certain level. If they try to flood the market with cheap stuff, we hit them with tariffs until the effective price is back above the floor. Now the math changes. You go from, this could be wiped out next year, to, I can live with this risk. That is the entire point of a price floor. It does not mean prices never drop. It means there is a line where the government itself steps in and becomes a buyer or a shield. Important, right now this is still a proposal, not a finished rule book. Congress, trade partners, and the courts will all have a say in how much of it survives. We have seen this movie before. In the 1970s, OPEC twisted the taps, and oil did not just get expensive. It rewired whole economies. Fuel costs jumped, inflation ripped, and policy changed because a small group controlled the flow. China learned that lesson. For years, they have controlled most of the processing for rare earths and other odd metals nobody cared about until exports were cut. Japan got a taste of that in the early 2010s when shipments slowed and factories had to scramble. That was a live demo of what happens when one country owns the choke points. Western governments helped build that trap. They liked cheap imports and clean hands. It was easier to close messy mines at home and let somebody else dig and refine. That is why they are panicking now. They know what it looks like when the other side decides to weaponize that control. Every time you hear politicians talk about de-risking supply chains or friendshoring, this is what they are groping toward. They are trying to make long-term projects bankable again. And for you, I'm sitting at home with a metals ETF in your account. That means the game you are playing is not the same game it was 20 years ago. Now let us zoom back to what actually happened this week. The State Department hosted the first critical minerals ministerial in Washington. More than 50 countries turned up. Europe, Japan, Australia, Mexico, a big chunk of the developed world, plus resource countries in Africa and Latin America. On stage, you had Secretary of State Marco Rubio opening the event, Vice President Vance pitching the plan, and a parade of ministers talking about one thing: how to get out from under Chinese control of critical minerals without blowing up their own industries. Right now, China processes the vast majority of the world's rare earth elements and a huge share of key battery metals. For some of these materials, they refine around 90% of global supply. That means if Beijing decides to cut exports of something like gallium or germanium, a lot of clean energy plans and defense projects stall overnight. We already got a taste of that. When previous tariffs were flying back and forth, China did not respond with feel-good speeches. They responded by restricting exports of some of these niche metals. They were not subtle about the message. If you lean on us, we lean on your supply chains. So what did the United States do this week? They laid out a plan built around three big tools. First, a new club, or at least the blueprint for one. They are not calling it a club on the podium, but that is what it is, a proposed preferential trade zone for critical minerals. If it ends up being implemented the way they described, members would agree on certain rules, and countries outside could face tariffs and quotas. Second, a national stockpile that actually matters. They branded one big program Project Vault. It starts with roughly $12 billion in funding between direct government money and private capital, with a clear mission. Buy and hold critical minerals for the United States and its allies so there is always a buffer. Third, price floors and reference prices. That is the part that made traders like me sit up straight. They are openly talking about setting reference prices for key minerals at different stages of the chain: ore, concentrate, processed metal, finished components. In the version Vance described, those reference prices would act as a floor inside the block. If imports came in below that level from countries that are not playing ball, the plan is to add tariffs and other charges until the effective price is back above the line. On paper, this sounds dry. In practice, this is huge. Let us talk about who this really serves. Governments in this new club want three things: control, stability, and votes. A floor under prices and a stockpile behind it lets them tell factory towns your jobs will not vanish just because Beijing tweaks an export rule. Big miners and refiners inside the bloc want predictable margins. If they know that below a certain price the government will start hoovering up supply or taxing cheap imports, it gets much easier to sign off on giant projects and take on debt. They get a safety net under their projects. You do not get that under your brokerage account. Large manufacturers just want metal that shows up on time at a cost they can plan around. They hate sudden spikes that blow up budgets. A managed floor might mean slightly higher average prices, but if it kills those shock moves, they can live with it. On the other side, China and other processing hubs want to keep leverage. They do not want rival chains with guaranteed support. Anything that weakens this club or slows it down buys them more years of quiet control over the tap. For decades, a lot of people in the industry say the game has looked the same. China poured money into mining and especially processing, often undercutting prices just as rival projects were getting off the ground. At the same time, big banks and trading houses were active in futures markets in ways that added even more pressure to the price chart. Most people write that off as brutal competition. Critics argue that, in some cycles, it has effectively functioned as economic warfare. Push prices down, starve rival projects of cash, let investment dry up, then tighten the tap again once you have more control. We saw a version of this play out in rare earths more than a decade ago. We saw it again when China announced new export restrictions on specific metals used in advanced chips. Every time, the pattern is the same: dump. Destroy investment, dominate, tighten. That is the structural villain in this story, not a cartoon bad guy. A set of incentives that push one country to weaponize its dominance, and a set of incentives that told Western elites for years that it was easier to outsource the dirty work. The summit in Washington is the first serious attempt in a long time to push back against that pattern, and it is not happening in a vacuum. In Australia, there are now dozens of active rare earth and critical mineral projects. That country has quietly become one of the main alternative sources for things like rare earths and gallium. A lot of that activity was kicked into gear by a deal signed in Washington last year, where President Trump and Prime Minister Anthony Albanese agreed to pour billions of dollars into joint projects. In Europe, our officials are scrambling to pass their own critical raw materials rules and are now talking to the United States about a formal pact on minerals. Japan has spent years building strategic reserves of rare earths after getting burned when China cut exports to them in the past. On top of that, the United States just launched a broader initiative called Pax Silica at the end of last year, which is all about securing supply chains for chips, artificial intelligence, and the hardware that makes this new digital empire run. Critical minerals sit at the base of that entire stack. So when you hear about one summit and one speech, understand this is part of a wider strategy. Governments are looking at the same chart you are, but they are not thinking in days. They are thinking in decades. Now we need to talk about what this means for actual metals and for you, because there is a very weird split here. On your screen, you can still get big swings in price. We just saw gold and silver take hits after huge runs. Miners can still get crushed on a bad day. Speculators still pile in and out, but underneath that noise, the system is slowly being rewired so that the downside risk for producers is capped by policy, while your downside risk as a panicked seller is not. Think about that for a second. If you are a miner inside this new block and the market drops below the official floor, there is at least a chance that tariffs or stockpile buying kick in to support the price. If you are the retail trader who panic sells your miners into that drop because you think the cycle is over, nobody is going to put a floor under your sale. Most people think governments are there to protect the little guy. In reality, most of this architecture is about making sure large strategic projects have predictable cash flows. That does not mean you cannot benefit. It just means you need to understand who the system is designed for and then ride along instead of getting run over. Let us get specific. The plan that officials sketched out for the next decade has a few pillars. Direct investment into mining and processing. That means the Pentagon, the Energy Department, and other agencies literally writing checks into projects that fit the strategy. Some of that is grants, some of it is loans, some of it is guarantees that de-risk private investment, a big national and allied stockpile. Project Vault is the headline piece, but countries like Australia are already building their own reserves. Stockpiles matter because they create a buyer of last resort. When prices crash below a certain level, the stockpile can scoop up material. That stabilizes producers and sets a floor. Imagine a simple example. Say the unofficial floor for a metal ends up around $20 a unit. In a panic, the paper market smashes the price towards $16. Without a stockpile, producers eat that whole move and start cutting projects. With a stockpile, once the price sinks below the line, that national buyer steps in and starts taking tons off the market. From your side of the screen, the chart still looks ugly for a while. Maybe you watch it slide from 20 down into the mid-teens and you feel sick. The investor who sells at 17 locks in that hit. The one who knows there is a real buyer waiting under the floor can either hold or add, betting that forced buying plus real demand pulls price back toward the protected zone over time. Price support through trade rules. Those reference prices and price floors we talked about, this is where it gets controversial, because you are basically telling the market the free part stops at a certain line. And finally, permitting and red tape. There is a push in Washington to shorten the time it takes to open a mine. Not from 3 decades to 3 months, despite the sound bites, but any serious cut in timelines would be a revolution compared to the world we had. If even half of this happens, it is a completely different world for metals than the one you have been trading in. So how do you position without doing something stupid? Here is how I personally think about it. This is not personal investment advice. I do not know your circumstances, and I am not telling you what you should buy. This is just how I sleep at night. Layer 1 is physical metals. Boring, heavy, not exciting on a chart, but very calming when the world goes sideways. I own physical gold and silver. I also hold some palladium because that market is tiny and can move fast when supply squeezes happen. And I do not keep it in a shoebox under my bed. It sits in professional storage with companies whose full-time job is not losing track of metal. The point of that stack is not to trade around every Fed headline. It is to be my base layer of savings that is outside the banking system, outside the app on my phone, and outside the promises of any politician. Layer 2 is liquid exposure through exchange-traded funds. For gold, I use GLD. For silver, there is SLV. There is also a pure-play copper fund called CPER that tracks the copper price. A lot of investors choose to have some metals exposure as part of a diversified long-term portfolio, but the right mix depends entirely on your situation, not because I think we are heading for the end of the world. But because metals are one of the few things that can protect you when inflation surprises or when confidence in government debt cracks. You do not need to reinvent the wheel here. A simple mix of broad stock funds, some bonds if you can stomach them, and a slice of metals ETFs gives you a base. Layer 3 is where the asymmetric upside lives. Mining stocks. When metals go on a run and the fundamentals are strong, miners can move 2 or 3 times as much as the underlying metal, sometimes more. The flip side is they bleed harder on the way down. That is the price you pay for leverage. If I want diversified exposure, I look at things like GDX for gold miners, SIL for silver miners, and a copper miners ETF like COPX or COPP. There is also XME, which is a broader basket of metals and mining companies. If I want to go hunting, I can pick individual names, but that is where you really need to know what you are doing, because a single bad project or a bad balance sheet can wipe you out even in a bull market. Let me also put metals in the lineup next to the other things you probably own. When inflation jumps faster than expected, broad stock indexes tend to wobble. Earnings get squeezed and valuations compress. Gold and often silver are two of the few assets that still catch a bid when people start doubting the buying power of paper money. When long-term yields spike, bond prices get hit. That is the math. A lot of conservative portfolios sit on that pain. Metals do not pay a coupon, but they also do not care what the central bank sets as the policy rate. When yields rip higher, gold has often held its ground or climbed because it sits on the other side of that debt. When mortgage rates jump, real estate slows, transactions stall. Prices can drift or drop, and you cannot sell a house in 30 seconds to cover a sudden problem. You can sell a liquid metals fund in one click. And when regulators decide they have had enough of Wild West crypto for a while, those markets can go dark or get choked. Governments can make it very hard to move in and out. They cannot print more gold or silver, and they cannot ban physics. The key thing is this: I do not go all in. I do not use heavy leverage. I do not assume that just because governments say they want stable prices, the chart will go straight up. Policy can change. Politicians can lose elections. Plans can stall, or they can overshoot and trigger a different kind of crisis. So instead of betting the farm, I am building positions in layers and time. Add on big dips, take a little off when things get stupid, always keep some dry powder, and never forget that your goal is to survive several cycles, not to nail one trade. Before we get to that fork in the road, I need to say this clearly. This plan can break. We are already seeing some of that pushback. One major report last week said the administration is backing away from guaranteed price floors for some U.S. projects because of funding and legal risks, even as it talks up allied price floors at this summit. The final architecture could end up weaker, slower, or messier than the speeches. The first risk is politics. Floors, stockpiles, and big checks all depend on who controls the budget. One election swing in Washington, Canberra, or Brussels, and the money can slow or stop. Projects that were counting on steady support can be left exposed. The second risk is lawyers and trade fights. The moment tariffs and reference prices start hurting exporters, you will see complaints at the World Trade Organization and in local courts. Cases drag on. While they do, some of these rules can be watered down or quietly gutted. The third risk is execution. Announcing a critical minerals push is easy. Getting permits through local councils, building roads, hiring crews, and actually pouring metal is hard. If the real-world build-out lags, the speeches, shortages, and price shocks can still bite. So no, this is not guaranteed. It is just the direction the grown-ups are trying to push the system. Now, before we close, I want to lay out the fork in the road we are standing in front of. There are three kinds of people watching this type of video. The first group shrugs and says, "This is all politics." They see the summit headlines, they hear about price floors and alliances, and they assume it will all fade away. They keep doing what they have always done. Mostly stocks, maybe some crypto, and maybe a little gold in a drawer somewhere, but no serious positioning. If they are lucky, nothing breaks, and they muddle through. If they are unlucky, and the bond market or the currency market really snaps, they wake up to find part of their purchasing power gone and no real hedge. The second group gets whipped around by every move. When metals are ripping higher and the news is full of bullish stories, they pile in at the top. When the first big pullback hits, they panic and dump everything. They are always arriving late and leaving early. They feed the system with their fear. The third group looks at what is actually being built here. A world where the biggest economies are quietly agreeing that key raw materials will not be allowed to trade like random penny stocks anymore. Where price floors, stockpiles, and alliances put a thumb on the scale in favor of people who bring real supply online. They understand that this is messy, that China will respond, that there will be trade fights and court cases and headlines, but they also understand that on balance, this environment is a tailwind for metals over a long window, so they build a plan. They decide how much of their net worth they want in physical, in ETFs, in miners. They accept that there will be scary weeks and annoying months. They do not confuse normal pullbacks with the end of the world. I am trying very hard to stay in that third group. I could be wrong. Maybe the alliance falls apart. Maybe voters in key countries toss out governments that back these policies. Maybe China finds some clever workaround that makes all of this look naive. That is always on the table. But when I look at the combination of Project Vault, the critical minerals block, the earlier rare earth deals, the Pax Silica initiative tying this into the whole tech stack, and the fact that more than 50 countries showed up for this summit, it is very hard for me to believe we are going back to the old world where Western elites pretend metals do not matter. Let us zoom way out. 5 years from now, when people look back at this moment, they will not remember every price wiggle. They will remember that in early 2026, the United States and its allies finally admitted they had a strategic problem. They had let one country control too much of the plumbing for the modern world. They had hollowed out their own mining base. They had treated metals as boring, old economy junk while building a digital universe that quietly runs on those minerals. This week is the first real attempt to fix that. From here on out, there are a few simple signals I would keep an eye on. Watch for headlines about governments adding to metal stockpiles. Every shipment into those vaults is the floor mechanism being funded. Watch for new tariffs or rules on cheap metal imports from outside the club. When you see duties jump on specific alloys or concentrates, that is the block drawing its line. And pay attention when big new mines or processing plants are announced with direct backing from governments or defense departments. Each one is a real-world bet that this critical minerals order is not just talk. So do not let a couple of rough days on the chart scare you out of the story just as it is getting interesting. Do not let boredom during the sideways months trick you into selling your insurance back to the very people who are trying to corner the supply. Screenshot this video, save it somewhere, come back in a few years and see whether metals were just another fad or whether this really was the moment governments turned them into strategic assets again. If you got value from this, subscribe and hit like so YouTube actually shows it to people, and share it with one friend who owns zero metals and needs to wake up. Whatever you do, do not sleepwalk through this. The rules for metals are being rewritten in real time. You can either be the person who only notices when the price has already gone vertical, or the person who understood the shift while it still felt uncomfortable and used it to quietly rebuild their future. I know which one I am trying to be.